Ever wondered how the US government controls the value of the dollar? It's through a concept called monetary policy. Just like gold, US dollars only hold value because they're limited. But unlike gold, the US government has a secret weapon, a printing machine. Today we're talking about the electronic version, which can churn out as many dollars as desired at virtually no cost. Monetary policy is a complex dance of balancing the number of dollars in circulation. By adding more dollars into the system or by simply threatening to do so, the government has the power to decrease the dollar's value in terms of goods and services. This is equivalent to increasing dollar prices for those goods and services. In other words, your dollar buys less when there are too many dollars around. But why would the government want to decrease the value of the dollar? The answer lies in the balancing act of economics. If the government needs to incur higher expenses, it might choose to increase the money supply. This creates inflation, which is a general increase in prices, and fall in the purchasing value of money. While it might sound bad, a little inflation is actually healthy for the economy. It encourages spending and investment, which are key drivers of economic growth. But there's a catch. If the government increases the supply of money too much or too quickly, it can lead to hyperinflation. This is when prices skyrocket and the purchasing power of the dollar plummets. It's a dangerous scenario that can lead to economic instability and even collapse. So, under a paper money system, any government can cause inflation by increasing the supply of money. But they must tread carefully. Too little inflation could stall economic growth, but too much could send the economy into a tailspin. It's a delicate balance, and one that requires careful management and oversight. That's why central banks, like the Federal Reserve in the US, play such a crucial role in managing the country's money supply and, by extension, the value of the dollar. What happens when there is a decrease in consumer spending? Deflation. Deflation is a term that can send shivers down the spine of economists and central bankers. It refers to a general decrease in the price of goods and services. And while that might initially sound like a good thing, it can actually be quite detrimental to an economy. When people expect prices to fall, they hold off on spending, which in turn causes prices to drop even more. This creates a vicious cycle that can lead to economic stagnation or even collapse. Central banks, such as the Federal Reserve in the United States, view deflation as a dangerous beast that must be tamed. They aim to maintain a positive consumer price index, or CPI, which measures the average change in prices over time. However, when credit, loans, and cash are scarce, the CPI can dip into negative territory, signaling deflation and a potential system collapse. But let's take a step back and talk about inflation, which is essentially the other side of the coin. Inflation is often perceived as the depreciation of the value of fiat currency due to an increase in the amount of currency in circulation. It's like adding more water to a soup. The more you add, the less flavorful the soup becomes. Similarly, the more money there is in circulation, the less each individual unit of currency is worth. Over the past 3 decades, the public's understanding of inflation has been somewhat skewed. It's often described as an increase in the prices of goods and services, which is actually a result, not a cause, of inflation. This misrepresentation can distort findings and lead to misinformed decisions. Did you know that 50% of the public in the US doesn't have any wealth? It's a staggering fact, isn't it? This is primarily due to inflation, an economic phenomenon that can erode the buying power of your hard-earned dollars. Inflation is often painted as a necessary evil, a byproduct of a growing economy. But in reality, it's a tool used by governments and central banks to subtly siphon off the wealth of the public. You see, when more money is printed and circulated, the existing dollars in your pocket lose their value. This is not a random process. It is carefully orchestrated. When the government increases the supply of money at a faster rate than the economy's growth, the value of the fiat currency depreciates. This depreciation is the real meaning of inflation, not the rise in the prices of goods and services, as is commonly understood. Ultimately, inflation is the state's responsibility. Could there be a clear intention to destroy the fiat cash currency? This question has been echoing in the minds of many. The concept of central bank digital currency, or CBDC, has been gaining traction, and there's a possibility that it could replace traditional fiat currency in the future. Let's take a trip down memory lane to the financial crisis of 2008. The bubble was inflated, and banks such as Lehman Brothers, Merrill Lynch, Morgan Stanley, JP Morgan, and Goldman Sachs stood like dominoes on the brink of collapse. They were bailed out, but the crisis served as a stark reminder of the fragility of our financial system. The crisis was limited to residential real estate, but it had far-reaching impacts on the economy and the value of fiat currency. Fast forward to today, and we're navigating through an economy that's still healing from the wounds of past crises. The lingering fear of another crisis is palpable, but this time the stakes are higher. The bubble is not limited to one sector, it's spread across the entire economy. It's like we're sitting on a ticking time bomb, waiting for the master of all bubbles to burst. The fallout from such a crisis could be catastrophic, leading to a systemic collapse. Some speculate that this could be a deliberate plan to phase out fiat currency and usher in the era of CBDC, but whether this is a calculated move or not is a topic of heated debate. The shift towards CBDC is not just about replacing paper money with digital tokens, it represents a fundamental change in how we perceive and use money. It's about taking control of the money supply out of the hands of the government and placing it in the hands of a decentralized system. So what does this mean for you and me? It means that we need to be prepared. We need to be aware of the potential risks and opportunities that this shift could bring. And one of the best ways to safeguard our wealth against the uncertainties of the future is to invest in gold and silver. Whether it's planned or not, the best way to prepare is to invest in gold and silver. After all, the only constant in life is change, and the world of finance is no exception.